Ladies and gentlemen, welcome to our annual Schelling lecture. I know that a number of you don't have seats, and we are adding chairs as I speak, but please, as the chairs get put out, feel free to grab a seat. It is my great pleasure to welcome you here today for a homecoming to Carmen Reinhart, who will be introduced in a minute by Susan Schwab, the dean who was smart enough to recruit her to this school. But it is a homecoming for Carmen, who spent a good bit of time with us. So in addition to being a perfect way to honor Tom Schelling, her colleague and beloved colleague, I think we will be treated to a Schelling-esque, if I may use that term, lecture today. I just wanted to say a word about the Schelling lecture and about Tom. I was just recalling as I sat with Carmen a minute ago that in the history of this school and the economics department, we've only had two joint appointments, Tom Schelling and Carmen Reinhart. That's pretty good company to be in going both directions. And so I'd like to welcome, first of all, those of you who are here from the econ side of the house. We always say we should do more with economics, and economics says we should do more with public policy, but this is a great way to bring the family together, Carmen, so thank you. Tom Schelling, of course, was best known once he received the Nobel Prize. When you have comma Nobel laureate after your name, that becomes part of your standard introduction, as it should be. But Tom Schelling was so much more than a Nobel laureate, and this recognizes not just his brilliance. And I was very struck in just going back through the terms of the Nobel Award to Tom in very kind of dry Nordic prose. He received the award for, quote, having enhanced our understanding of conflict and cooperation through game theory analysis. That's about as dry and brief as you can make it. And for those of you suffering through game theory these days, I'll apologize on Tom's behalf for creating the field. But it is what Tom did with those powerful tools that he helped develop. He, yes, did look at conflict and cooperation in very new ways. He applied it to just about everything under the sun. Avoiding nuclear Armageddon, solving the very new field of climate change. But he also brought these powerful tools to focus on very individual behaviors, things like addictions and smoking cessation. The fact that he could cover such a wide range of issues and use these tools with full recognition that the substance was different, but he found a way to make those tools work. So whether the tools are economic tools or policy tools, Tom Schelling did it with great, great distinction. But to many in this room, Tom was also a beloved colleague. Tom Schelling just had his way. It wasn't just the brilliance of his brain, it was also his heart. And he gave of himself very freely to his students, to his colleagues, and to this community. So it's in Tom's honor that we're here today. It's my great pleasure to welcome Carmen home and to turn it over to Dean Schwab to introduce her great catch.
Thank you, Dean Orr. I am thrilled to be here today to welcome and to introduce Carmen Reinhart. The connection here, by the way, is not just that I was dean when Carmen was recruited here, but Tom Schelling was the chair of the search committee that recruited me as dean. So there is this path. I'm looking at Peter Reuter, he recalls, although he had questions about whether I should have been recruited, but he was on the committee too. Anyway, and Mac was on the committee, but Carmen was this marvelous catch when she came to the school. And I would note she came to the school and joined us before she joined the econ department, and then we were delighted to welcome the econ department to share, because we are cooperative, collaborative people. Carmen is now the, is it Minos? I pronounced it right. Minos A. Zombanakis Professor at the Harvard Kennedy School. She has been a senior policy advisor, deputy director at the IMF. Before she came to us, she was at Bear Stearns. So she was in the private sector, and so she is in this marvelous category of scholar practitioners that we are so proud of here at the School of Public Policy. That was when I met her initially. She served as chief economist, vice president at Bear Stearns. She was at the IMF working with Ken Rogoff as deputy director, and as you were Ken's deputy, right? And with Ken Rogoff has written a seminal work on financial crises, but I think you're going to be talking more about that. But the title this time is different. 8 Centuries of Financial Folly, I think, says it all, because when we walk into the classroom, when you hear people talking about what's going on in financial markets, everyone thinks it's all new and different, and guess what? It's not all new and different. And Carmen and Ken did an incredible job of articulating that in their seminal work. Carmen, if you keep track of these things, is ranked as one of the top economists in the world, and clearly one of the top women economists in the world. She shows up in Bloomberg Markets top 50 influential economists in finance. She shows up in the top 100 in foreign policy, and Thompson Reuters most influential scientific minds, and so on and so on and so on, and is widely published. But above all, she is an incredibly cool person, a wonderful thinker, a great friend, and we are just delighted to welcome you back to the University of Maryland, the School of Public Policy, and the Economics Department. Thank you. Please help me welcome Carmen Reinhart.
Well, it's a pleasure and an honor to be here, also seeing so many familiar faces. I don't want to use old familiar faces, but it really is also an honor, given how big and sincere an admirer of Tom Schelling yours truly was. It was a real pleasure to get to know him, and I remember when I came to interview at Maryland, he was, one of the meetings I had, and it was a wonderful conversation, and I was impressed then, and only became more impressed over time with Tom. I want to make a disclaimer. I had nothing to do with Bear Stearns' failure. It was many years before that that I was at Bear Stearns. So what I'd like to do is commingle my current research with the overall theme of global risks, the legacy 10 years after the financial crisis. So give me about 10 minutes to warm up, kind of lay the stage, and then feel free to interject with questions or commentary throughout. Let's not wait till the end. And somebody has to tell me when I'm close to finish, because I'm known to ramble, so I could go on longer than the talk is intended. So let me start with a roadmap. I am, and I'll flag the material that I'm currently working on as I go along. I'm going to start with some work that Ken Rogoff and I did, not the book, subsequent to that, an analysis that we did of the worst 100 crises in history. I'll start there and compare it to 10 years after the crisis. How did the crises of 2008, 2009 compare? I'll start there, and I'll talk about, I think, what are predominantly advanced economy risks in the context of very low interest rates and the incentive to take on risks. I'll move on to emerging markets and developing countries. The Turkish contingent is well represented here, so I will talk about classic emerging market crises, and this encompasses Argentina, it encompasses Turkey, it encompasses a lot of the difficulties we're seeing, but I also want to focus on some recent work that I've done in connection also with Chinese lending that I think is a new element in emerging market and developing country finance. And then I'll conclude with some work that I've been doing on the use of the dollar as the reserve currency and some of the challenges that I think, so view the first two blocks as more short-term risk, and then the medium one, the last one as risks over a much longer horizon. So let me start with what I call the unresolved debt crisis. I mean, people ask me, so when is the next crisis? And my first response to that question is often, we're actually not quite done with the previous one. And let me start here. This is, Ken Rogoff and I, as I mentioned, did a study of the worst 100 crises from about 1850 to the present, banking crises. And one of the ways of gauging severity is to look at how long it takes you to recover. And by recover, I don't mean any really rich kind of analysis in terms of going back to potential output or going back to trend. I'm talking about the minimum minimorum definition of recoveries. How long does it take you to get to the income level that you had before the crisis? So how long does it take for per capita income to go back to where it was before the crisis? And the column circled there looks at the 11 crises, systemic crises in the advanced economies. They're listed right there. So I don't need to repeat the countries that I'm referring to. But in looking at the worst 100 crises, what Ken and I found was that on average it took 7 years to recoup the per capita income level you had before the crisis. Now, one of the things that you hear is we're so much more sophisticated, we have so many more, richer policy tools and so on, but yet on average this time it's taken us closer to a decade. The US recovery was not the fastest was Germany, but then Germany didn't have a housing bubble like the US, like the UK, like Ireland, like Spain. Germany had a banking crisis because they bought US subprime paper. That's sort of, and this is, keep that in mind because that's something I'm going to go back to when I talk about the current situation and global risk taking. So Germany had a banking crisis not because they had their own bubble, but because they borrowed into somebody else's bubble. And the bottom line is the US recovery, 6 years, was pretty much on track to the historic norms. But in Europe, the recovery was much slower, and notoriously so in Greece and Italy. When I say the crisis is not over, I'm not being flippant. Quite the contrary. If you take the IMF World Economic Outlook, and they do projections out to 2023, and they, on the whole, tend to be optimistic. And even out in 2023, neither Greece nor Italy will have the per capita income they had in 2007. And in effect, Greek bank deposits are below what they were when they joined the Eurozone. So you're talking really about, this is not about the lost decade. We're past that. This is now, you know, a couple of decades. Because as I said, even by 2023, the outer year in the IMF forecast, they will still have not recovered. And related to that, not surprisingly, both Italy and Greece have a very serious debt overhang. And what is shown here, basically, is Italian debt since Italy was unified in 1861. The light pink shading is what you hear about all the time. This is general government debt. Everybody knows Italy has debt of about 130% of GDP. And in fact, I will argue here that Italy's debt is not 130% of GDP. It's actually 160% of GDP, and that's not a trivial difference. The difference is, how many of you, don't be shy, have heard of Target 2 balances? Okay. Well, Target 2 balances basically is what keeps the euro as a single currency, okay? So if you're an Italian bank and you don't want to hold Italian assets, okay, you sell your Italian bond to the central bank, the Bank of Italy, and you go and buy a German bond, okay, or put a deposit in Germany. That's a capital outflow from Italy to Germany. In the normal course of things, for countries that are not part of a currency union, that would be a loss of reserves. In Europe, it shows up as an IOU, a negative in Target 2. So the Bank of Italy now has debt to GDP of about 30%. Spain has a comparable amount. Portugal has roughly twice that amount, and Greece more than that. So you're, oh, oops, sorry. So that's that little red line over there. So the indebtedness situation is one that hasn't been resolved. My own view, and we can discuss, is that at some point, some of these officially held, because this is officially held debt, are going to end up getting restructured. Okay? Whether restructuring takes the form of changing, you know, the maturity, the terms, the maturity, or actual haircuts, that remains to be seen. But I think the European crisis of 2008, 2009 has yet to be resolved. And highlighting that point, here is a comparison of different crises, peak to trough declines in housing prices. And the only thing I want to flag to you here is that for Italy, it's not one of the biggest declines, but the worrying part is it's ongoing. In other words, housing prices have been declining for a decade. So that's a risk among the advanced economies that is not new, but it's very much there. Let me turn now to what are some of the new risks. I said this was not going to be an uplifting, you know, I mean, it's by definition, if you're focused on risks. So, yes. Because risk refers to the odds of a crisis. And it could be another banking crisis. It could be a sovereign debt crisis. Or it could be both. Or it could be a currency crash if ultimately they leave Eurozone. So there's a crisis edge to it. So the term risk is that the odds of one variety of crisis, one or more varieties of crisis, is present. So they haven't grown not just in the last decade, they weren't growing even before the global financial crisis. In the case of Italy, not in the case of Greece. Greece was growing very rapidly before the crisis. But the odds that, you know, a debt crisis, a pullout of Eurozone, is very much alive and well. And in the next one, my focus now turning to what are some of the new risks. My next topic is risks of another bubble, another fresh financial crisis. So in the context of the European discussion, you know, we remember in the summer of 2015, we had all the discussion of Brexit, right? Nobody here remembers 2015? Okay. So, you know, we had the possibility that Greece could pull out. We had, you know, currency, debt, financial crisis, a real possibility. What I'm going to talk about are what are some of the components that begin to look bubbly in the US, in Japan, and in Europe. And here the risks are associated with what if that market that I'm going to speak on, I haven't said a word about it yet, is another mortgage-backed securities episode. That's the risk that I'm focusing on here. So what this chart shows here is the US federal funds rate, the policy rate of the Federal Reserve. That's the green line, and the blue line is the financial conditions index that Goldman Sachs puts together, and that looks at, you know, liquidity conditions. It looks at exchange rates. It looks at equity prices. It looks at short rates, long rates. It's a variety of indicators that measures financial conditions. And up until 2018, we really had very, very exceptionally accommodative financial conditions, despite the fact that the Fed began to tighten at the end of 2015. That's the point made here, okay? That the Fed began to raise interest rates at the end of 2015, but liquidity conditions, financial conditions remain very ample. In Japan, this is important, in Japan and in Europe, monetary policy has even been more accommodative. Negative interest rates. For example, the Bank of Japan also has a ceiling on the long bond The long bond is capped very close to 0, 10 basis points. What am I getting at? I'm getting at what is probably the most exceptional low interest rate episode that I am aware of in the last 200 years. And so with these exceptionally low, and in the case of Europe and Japan, negative short-term interest rates, what do investors want? If you're a saver, what do you want? You want high yield. I mean, and if you're a commercial bank, you're actually suffering losses from these low interest rates. So if I'm a bank in Europe and I'm making deposits at the ECB, I actually have to pay to make that deposit. In other words, the search for yield induces banks, induces investors, induces pensioners to take risks in search of that yield. And this is what I want to focus on next. In the context of the US, remember, we're very good at creating new instruments and, revamping old ones and so on. The hot market, or very hot market, is the so-called CLO market, the collateralized loan obligations. Okay, these are pooled loans, often, not always, of lower tier firms. You have every quality in there, okay? It's like mortgage-backed securities. You had very good, solid pool of mortgages, but you also had very riskier ones. And you have some of the same packaging that we saw during the mortgage-backed security bubble, in that the CLOs, the collateralized loan obligations, are sold to investors, and there is no long-term connection as in the old days where a bank would make a loan and that loan would be on their books. No, you've decoupled. The lender is decoupled from the ultimate holder, which makes the lender or the intermediary more willing to make the loan, or more willing to facilitate the loan in the first place. So one of the things that's happened in this low interest rate environment, in this high liquidity environment, is that we've seen a big growth in these collateralized loan obligations. And the relevant question to ask, I will explain this chart in a minute, is that our new mortgage-backed securities bubble? I will just briefly touch on the similarities and the differences with what we saw as a precursor of the 2008-2009 crisis. The 2008-2009 crisis was prefaced by a big rise in leverage, in debt, the debt of households and the debt of the financial sector. We're not saying that now. The concern now is corporate debt. It's not household debt, it's corporate debt. But it doesn't matter. You can have a crisis with any kind of debt, whether it's household, corporates, or government. But the nature of the crisis changed, but that's what we're seeing. We're seeing a renewed buildup in leverage. And I haven't gotten to this yet, but I will highlight that what is happening in this market has eerie similarities to what happened before the 2008 crisis. The US was creating these mortgage-backed securities back in 2006 and 2005 when the housing market was booming, and Japanese banks and German banks were buying them in great quantities. We're back to that. Some of the largest buyers of CLOs are Japanese banks. This activity is also taken off in Europe. What am I saying? I'm saying the GFC, i.e. global financial crisis, was global. It wasn't actually an emerging market crisis. It was an advanced economy crisis. But it was spread across countries because of these interrelations. And we're seeing that again. Before you get too depressed, I would highlight that the more uplifting comparison is that the orders of magnitude are nothing comparable to the housing market. Okay, mortgage-backed securities are a big market. I mean, this is the biggest form of wealth. Housing is the biggest form of wealth for US households. So the scale that I'm talking about is not the same. So keep that in mind. Same risk-taking profile, same leveraging, same cross-border channels of contagion are there, but much smaller scale. What this chart, yeah, John?
So there's another difference maybe, which is that the housing, problem with housing loans is that they're collateralized by houses, and therefore the risk is inherently tied up with the house price, which is subject to aggregate fluctuations, as we now all know. I mean, there maybe isn't something comparable with corporate debt. These are not collateralized by necessarily by corporate capital whose value
But hang on. For some of them, a lot of the U.S. CLOs, we've become an oil exporter, okay? So a lot of the CLO activity is concentrated in our relatively new energy. So a lot of them have oil prices in the scene as your collateral, okay? So we are tied to the commodity cycle in a way that we weren't before. But it is, you're absolutely right, that, and importantly, the fact that housing prices were the collateral behind the mortgage-backed securities also meant that when housing prices collapsed, and they fell more than 30%, it really hit household wealth in a big way. That's not the scale of what I'm talking about here.
So it might be more like we might be back in 1986 when we had a banking crisis because the oil prices collapsed and all the companies in Oklahoma
I mean, it's more like possibly it could be more like a tech bubble. It could be something that perhaps has less ramifications for the real economy, but nonetheless, in what is, I think, a globally stressed financial system, even smaller shocks may have bigger repercussions. And here, we have to say this at a policy school, what levers of policy to respond to a shock does, at the moment, Europe have, for example? If I discussed Italy, or we can discuss France, or we can discuss Greece, but if you can't do monetary policy because Italy doesn't have monetary policy, the ECB can do monetary policy, but they're already at negative interest rates. And many of these countries have more debt, so very little, more debt that they can handle and very limited fiscal space. This does not apply to Germany, obviously. So what I'm getting at, John, is that even smaller shocks could be in this environment, more destabilizing. Now, what am I showing here? What I'm saying here that it's sort of, you can take it as a sign that the emerging markets are being penalized really badly, or you can take it the sign that the high yield market in the US is bubbly. And I'm inclined towards the latter interpretation. The blue line is the high yield corporate bonds in the US. The gray line are the MB, the Emerging Market Bond Index. Historically, high yield debt, whether it's a corporate bond or a sovereign emerging market bond, move up and down together. What has happened in the last couple of years, that is, emerging market yields have gone up and corporate high yields have not, which again, you could say maybe emerging markets are being, maybe the risks in emerging markets are being overstated, or the risks in the US corporate market are understated. I'm inclined towards the latter interpretation. So, in a nutshell, what I've tried to do is give you, I could go on. I mean, on trade alone, there's a whole layer of risks to both advanced economies and emerging markets. But what I've tried to do is be selective to talk about some old risks, the legacy of the prior crisis, and some new risks that are brewing. Now I'm going to turn to emerging markets. And the reason I want to, okay, first of all, Shenmin. Yes.
When you started all that discussion in terms of the zero interest rates and negative yield, so when Japanese banks are looking for, yield,
Yes.
search for yield, they come to the high yield market in the US, right?
Yeah.
They can also go not just to emerging stores, but emerging corporates. I mean, emerging corporates actually got into the scene in this, during this, extremely accommodative environment since 2008, right? So, which is going to be even higher yield, right? If you're really after any yield. So, if you add that here, then probably that's going to strengthen your.
And one of the risks in emerging markets now is not just, as you know, I mean, in the case of Turkey, is a good illustration of that, that is not necessarily public debt, it is corporate debt, corporate external debt.
Exactly.
That also has that. Let me also add that, I will conclude on the advanced economy. When I mentioned Japan and going into CLOs, Japanese banks, they're also going back into real estate. That does tell you something about the degree of risk-taking as a consequence of the low-rate environment. But let me turn to emerging markets. And the first thing I have to say is, oftentimes, especially in an older era, people sort of went to sleep. You might have done that already, but people often went to sleep when you brought up emerging markets. Emerging markets were about 30% of global GDP in 1980, but they're about almost 2/3 of global GDP now. So, and this is of course importantly led by the shift in China. But you're really talking now about a dominant footprint in the global economy. So no discussion of global risk can be complete without it. And then, so what I'm going to talk about next is one of my pet ongoing projects regarding the curious case of the missing defaults, which sounds like a Sherlock Holmes story, and it has some elements of mystery. So let me start with the curious case of the missing defaults, explain what it is, and then talk about external factors and classic emerging market crises, which are two related but different kinds of risks in emerging markets. So let's start with the curious case of missing defaults. The curious case of missing defaults refers to the following. If you look at the last 200 years, this is based on work that I've done with Vincent Reinhart and Christoph Trebesch. If you look at the last 200 years of global capital flow cycles, inflows and outflows of international capital into emerging markets. By the way, capital flows was my topic of presentation when I was interviewed in Maryland many, many years ago. When you look at international capital flows, there are big external factors driving those flows. One is commodity prices, right? If you are a commodity producer, if you're Chile, if you're producing copper, when the price of copper is up, you're the darling of the world, capital flows in, Chile is very attractive. When commodity prices, when copper prices fall, capital tends to flow out. For starters, your export proceeds decline, right? I mean, the price of what you export declines. So commodity prices, booms and busts in commodity prices, historically play a big role in driving global capital flows. So do international interest rates. When U.S. interest rates are high, capital tends to stay in the U.S. more. When U.S. interest rates or interest rates in Europe and Japan are low, you have the search for yield that I've already described. So as Schelling pointed out, EM corporates and EM governments also can attract financing. Now, in 2 minutes, I'm going to try to give you a history of the last 15 years as regards these variables. And China is the critical player in this. Between 2003 and 2013, emerging markets had very solid, above average growth on the whole. This was especially true for primary commodity exporters. So Latin America, Sub-Saharan Africa, especially had a really good decade between 2003 and 2013. And think about it. All the global factors, all the stars aligned. You had very high commodity prices. China was growing at double digits. So their demand for commodities and their imports in general reflected that double-digit growth. International interest rates were low. Furthermore, post-crisis, they were quite stable. That golden era from 2003 to 2013 came to an end. In the spring of 2013, we had what was called the taper tantrum, when the Fed announced that it would raise interest rates. Capital started to pull out of emerging markets. Then you had China's slowdown was associated with a huge drop in global commodity prices. 2015 was not a drop, it was a collapse in commodity prices. Historically, what Trebesch and Reinhart and Trebesch show is that every time you have a collapse in commodity prices, a reversal in capital flows, the share of countries in default, in sovereign default, the new defaults increase. That's what this shows. This black line here is the share of sovereigns in default. And what we have is in 2012, commodity prices already started to slide down. You had a reversal in commodity prices, you had a reversal in capital flows, but no spike in defaults. So this is the curious case of the missing defaults. And what are the hypotheses? And I will go quickly. So here's just the checklist. Commodity bust, capital flow bust, but no spike in interest rates. But we have about, since 2011, we have about 15, maybe even 20 missing defaults relative to historic patterns. Let me give you 3 hypotheses, and they're not mutually exclusive. One is emerging markets manage the boom better. Better policy. So better policy in good times meant less likelihood of crisis in bad times. Better luck. That external factors have remained more favorable in the past. US interest rates have risen, but this is the most gentle increase since the Federal Reserve was founded before the beginning of World War I. Okay, so in the history of the Fed, this has been by far the mildest increase in interest rates, the slowest and the mildest. So basically that shoe really didn't drop this time around. Remember, these are not mutually exclusive. Third, and I'm going to argue that this is important, we're mismeasuring defaults here. Because, and this is the big new item in global finance is the one we can measure the least, and that is Chinese lending. I have a whole new project on documenting Chinese lending. Chinese lending takes the form of development loans. It takes the form of foreign direct investment that also has a high debt component. It takes the form of asset purchases, i.e. when they buy a US Treasury or when they buy a Malaysian Treasury, that's still lending. And it takes the form of the People's Bank of China giving a line of credit, a swap line, to another country. Argentina has a huge swap line from China. So what I'm going to show you is evidence that those defaults have been off our radar screen, but they've been happening. Let me explain. Credit rating agencies only really care in terms of tracking about private creditors lending to sovereign borrowers or to private borrowers, but it has to be private creditors. Chinese lending is not a private credit, it's official credit. So you would say, aha, therefore, if I want data on Chinese lending, I don't go to, sources that track private lending. But China's not part of the Paris Club either. The Paris Club is the institution that governs the modes of official lenders, i.e., if the US were to make a loan to Zambia, if France were to make a loan to Cote d'Ivoire, those loans are recorded, scrutinized, and so on, under the Paris Club. China is not a member. So China's lending does not appear in the Bank of International Settlements. Most of Chinese lending is not included in the World Bank data. Chinese lending is not recorded in the Paris Club database. And so we basically know very little about Chinese lending. This is what Chinese lending looks like. It's about 6% right now of world GDP. They're the largest official creditor. Now, a big chunk of that, the blue, is just straight purchases of US government securities, i.e. US Treasuries. Let's be very clear. At present, according to the flow of funds data from the Federal Reserve, the rest of the world holds about 40% of US Treasuries. At the time of the crisis, in 2008, it owned more than half. A good chunk of that was China. Anyway, the blue is purchases, not just obviously of US asset purchases, but asset purchases in the rest of the world, of other countries in the rest of the world. And the green are the foreign loans and the trade credits, which are huge and largely unrecorded. This is a big effort that we've had for a couple of years tracking down this data. But here's the killer, in my view. Where is this lending going? It's pretty much of one form or another. It is going, the direct loans are the red. The lines, the central bank lines of credit, which does not imply those lines have been used, is in green. And I haven't even included asset purchases in this map. So basically, what I'm saying is the footprint of Chinese finance as the world's largest official creditor is everywhere. Of all this lending, what do we know? Let's go back, let's not, ramble on a side issue. What do we know about defaults? Well, in effect, there have been about a dozen, this is not the full list, there have been about a dozen defaults since 2011 that are off the radar screen of the credit rating agencies, but these are debt restructurings that are with an official creditor, which the credit ratings don't pick up. And so our missing defaults perhaps is not as missing if we added the dozen or so countries that have restructured their debts to China. Okay, any questions or any issues on this?
I've been thinking about this a while, is that curious to hear your thoughts on the idea of secular stagnation in OECD countries. Sort of the idea, and I'm not, just to hypothesize a little bit, that maybe the economic data that we're getting nowadays is so well monitored in the digital era that we're able to pull back at the slightest instance of I mean, just to quote China, for instance.
Let me, I'm going to go back. I will certainly discuss secular stagnation at the first, but on China, did you have any?
I have a question about China's contribution in terms of global debt crisis. Well, what's your perspective on the potential impact of the recent Belt and Road Initiative, basically building massive infrastructure? So on one hand, it basically caused those countries to lend a lot of money, but on the other hand, massive infrastructure also can spur local economic GDP, and which can attract capital inflow.
So I have not said, so first of all, a lot of this lending that you see is under the Belt and Road Initiative. Okay, not the asset purchases, not the swap lines of the central bank, but a lot of the loans and a lot of the FDI is under the Belt and Road Initiative. And let me say this, up until the moment, China started lending, don't worry, I will get to your, China started lending at the very low, to the very lowest income countries, countries that largely had no access to capital markets. It has continued to move up the ladder. It is now, Belt and Road is now a big part of the discussion in Europe. I would observe that Chinese banks have been making loans to Greece, to Greek shipping. Chinese lending has also come to the forum of discussions in Portugal, in Italy, and Switzerland also joined the Belt and Road Initiative. So when I say that this is a big global footprint, I haven't said anything about good or bad, okay? Is it the pluses or the minuses? I think what your question is it good or bad? And it's both. It's like any wave in lending, okay? Like the commercial wave in lending of the banks in the 1980s, or, and let me just highlight the good and bad. On the good side, it is lending that often has been associated with infrastructure projects that might have never happened, okay? Still on that note, the downside is it may not be the best projects. Okay, that's always, so you do have white elephants in there as well. The single biggest negative in all of this is the opacity. That, and this is what I'm going to get at, that if you're the IMF and you're trying to do debt sustainability for the Republic of Congo and you have no idea what the Republic of Congo owes to China, you've got a problem. And so the issue of lack of reporting, lack of transparency, I would say is the single biggest danger, because what it often leads to is overlending, including overlending within China as well. You have, different development banks competing to lend to the same country. So there is this really lack of tractability that is a problem.
I think we have time for one or two more questions. Sorry.
Mm-hmm.
Do you have a thought or a picture of a scenario in which China may be feeling compelled to pull back or withdraw some of these loans, and could that be a possibility of the risk?
Absolutely. Absolutely. I actually wrote a project syndicate piece on that very issue. That, look, and this is not unique, the U.S. commercial banks in the 1970s overlent to emerging markets when commodity prices were high, because the view is commodity prices are going to be high forever. These are great credits. It turned out not to be the case. I think some of the Chinese loans occurred during the euphoria of the high commodity, and those loans are souring now. So I do think that it's not a global statement about pulling back in the blanket aggregate, but they are pulling back certainly with some of the countries that have had debt difficulties, and nowhere is that more clear than pulling back from Venezuela, for example. During the earlier years when oil prices were still high, lending to Venezuela was very high. In the last few years, it's been nothing but repayment. Okay, so this is what Guillermo Calvo has called a sudden stop. And that is also happening. Let me say my last, how long do I have?
Just a few more minutes.
Okay. Well, and I also want to answer this gentleman's question. Let me conclude with a classic emerging market crisis, because it's hard to pick up the press these days without reading about the fragilities in emerging markets. If it's not Argentina having an IMF program and difficulty with taming inflation, Turkey has been in the news, the most recent being something that was reminiscent of the Asian crisis. That is to say, the central bank did not have the reserves that everybody thought they had. They had half of that because some of those reserves had been borrowed in the futures market. This is an old story. The same was true of Thailand. The same was true of Korea in 1997. In other words, when countries are in trouble, they fudge statistics or just simply conceal them more. But this is from a paper that is forthcoming that I did with some IMF former colleagues on the outlook for emerging markets. Emerging markets, first of all, emerging markets cover a spectrum of very different outcomes. But as an asset class, as a group, it is going back to my original theme of global risks, okay? Because the last takeaway from the discussion of Chinese lending is the global risk there is that these countries have more debt than we know. The countries that have borrowed from China because of the opacity of the data, or lack of data, have more debt than we know. Emerging markets are also in a position where even by the end of 26, and now even more so in the end of 2018, they already have external exposures to dollar debt that by historic standards have already ended badly. Meaning, if you look back to the onset of the debt crisis of the 1980s, debt levels, and actually if you take it out to 2018, debt levels are already in a region that has been associated with a lot of vulnerability and a lot of crises. So just to complete the conversation in a really uplifting way, now let me talk about secular stagnation. So look, my colleague Larry has been, really pushing the issue of secular stagnation, and I think it's hard to argue that demographic trends in the advanced economies are not conducive to a secular lower growth rate, okay? It need not imply lower per capita. I mean, let's not confuse. Japan is a case in point where, if you believe the IMF, by 2040, they'll have 25%, they'll have a 25% drop in population by 2040, okay? So on a per capita basis, it's not clear that they're doing worse, but certainly if you look at growth rates, I think it's hard to argue that demographics are not a negative factor for a lot of the advanced economies. That's also true for Italy. Beyond that, look, if you want to predict technological change and productivity, be my guest. But let me say the following. Economists are notoriously known for extrapolating. And I've told to Larry also. In the 1970s, by the end of the 1970s, the buzzword was stagflation. We were doomed to have high inflation and low growth forever. Then something happened, namely Paul Volcker. And inflation in the US and other advanced economies came under control, and growth picked up. The 80s was, it gets better because we never cease. Then in the 1990s, we had tamed the business cycle, the great moderation. We know how well that ended. And now we're in secular stagnation. Inflation is dead. The other day I saw the Bloomberg Business Week, inflation is dead. Is inflation dead? I had a dinosaur, dead dinosaur. I said, this starts to worry me about inflation now. Because every time we become this convinced that, no, this doesn't happen again. So, as I said, to be in a nutshell, I do think demographics is a secular downforce. Technological change is something I'm not willing to predict. You range from the very negative outlook to a very positive one if you listen to a lot of the tech people too. But I will also add another factor. Don't confuse secular factors with the debt overhang that we have in advanced economies. Advanced economies have the highest levels of debt since the end of World War II. And at the end of World War II, we had a lot younger population and a lot more room to grow because also good chunks of Europe and Japan were being rebuilt. And so I think debt overhangs are also, given my work with Reinhart and Rogoff and my work with Rogoff, debt overhangs are also a dampening factor that are not as immutable as secular stagnation, but are a negative influence.
Carmen, thank you so much. You didn't promise uplifting, but I don't see people staring at their toes, worried that the sky is about to fall. Maybe it's just because we're a bunch of risk junkies around here. Everyone wants to analyze. But I would just like to thank you by saying, taking the historical sweep that you have, in addition to trying to put what we're living through in historical perspective, I think you've done the perfect blend of your embodiment of a foot in the discipline of economics and a foot in the discipline, if I could call it that, of public policy. That we need more of. I think Tom would be very proud. Thank you. And I have a little memento to thank you for being our Tom Schelling lecturer this year.
Thank you.
Thank you.